All right, let's get started. Good morning, everybody, and thank you for joining Thompson Hines Weekly Coffee Chat Series. My name is Owen Pinkerton. I'm a partner in Thompson Hines Investment Management Practice Group. This is the second webinar in our weekly Coffee Chat Series. These concise and practical discussions are intended to focus on a variety of developments that impact the financial service industries. Joining me today is my colleague, Bibb Strench, Investment Management Partner at Thompson Hines, and Jason Toussaint, who's head of exchange traded products at Cryptoin, and he's the former CEO of Spider Gold Shares, or GLD. In today's session, we'll explain what an exchange traded product is, discuss its benefits and the challenges associated with launching an ETP, especially a Bitcoin ETP. That's going to be the focus. If you have any questions or comments during today's program, we encourage you to join the discussion by using the Q&A box on your screen. We will address and answer your comments as we move through our discussion. We'll try to leave a few minutes at the end for questions as well. To the extent we are not able to answer the questions, if we run out of time, we'll address them after the end of the call. Special shout out to Jason, who's joining us from Singapore. So Bibb and I are, this is a coffee chat series, and we'll be drinking some coffee probably during it. I don't know that Jason will, but thank you we're very pleased to have him despite the time differences. So before diving into the Bitcoin ETP product, let's take a step back and discuss what an ETP is, how it differs from an exchange traded fund or an ETF, and the process for getting approval from the SEC to launch an ETP. Bibb, can you take us through, give us a summary of these steps, what's involved with all this?
Sure, Owen. So let's start with nomenclature. Neither the SEC nor consortium of financial institutions have been able to standardize the name of funds that invest in securities or Bitcoin or other instruments. So for our purposes today, when we mention an ETF, an exchange traded fund, we're talking about a fund that invests in securities. When we talk about an ETP, an exchange traded product, we're talking about a fund that invests in Bitcoin or other non-securities assets. So it's a fund. It's most commonly organized as a trust, and its interests in the trust are the shares, and they're obviously offered to investors, and those shares can be registered or not registered. Very similar in structure to an exchange traded fund, an ETF fund. Obviously, that's been phenomenally successful product, attracting trillions of dollars. So when you're considering a Bitcoin exchange traded product, one of the things you should consider is the actual asset. So technically, not all cryptocurrencies are not deemed to be a security. So you want to make sure the cryptocurrency is not a security. If it were, that would subject you potentially to the 1940 Act, and you wouldn't get very far. So Bitcoin, for example, in the test you employ, when you're in Sec Reg class in law school, it's the SEC v. Howey case. And if the instrument is freely tradable, it's not controlled by a single person, a person's not gathering profits from the operation of it, then it likely will not meet the definition of security, and the SEC has taken that position with respect to Bitcoin. The reason I bring that up is that there is a recent case going on. It's a cryptocurrency called XRP, and it's sponsored as Ripple, and the SEC has taken them to court, claims that XRP is a security because Ripple, in effect, is able to control it. They're earning, they have the hardware and software behind its trading, and they're able, in the SEC's view, to have all the attributes that make it a security. So let's assume you're investing your fund in Bitcoin or a cryptocurrency that's not a security. There are really three options from a structure point of view. what we'll talk about really the first two a lot today. You can register the shares on the fund with the SEC. You can try to list those shares on an exchange through a 19B4 application filed with the SEC. And then hopefully have a product that's freely available and traded on exchanges. Nobody has been able to get over that hurdle as of yet, and we'll talk about that today. You can also go a second round and register the shares, make them available to only accredited investors. They have restrictions on the ability to sell them, and eventually they can become available on a over-the-counter market. Obviously less robust, as we'll talk about, compared to a something like a GLD, which is traded on an exchange. And the product there that's most noteworthy is Grayscale. Lastly, I'll just mention quickly, you can have a hedge fund that invests in Bitcoin and privately offer those interests. Again, you're going to be hit with transfer restrictions and also restrictions on whether either the person has to be an accredited investor and other conditions to avoid it being deemed to be an investment company.
Thanks, Bip. So that was a nice segue by mentioning GLD. Jason, you've been through this process before. You were involved with getting GLD approved in the first place. That was the first ETP for a gold product. And there's some similarities between there might be some similarities between the gold and Bitcoin markets and some of the difficulties associated with getting registered with the SEC. Are there since having been through this process before, anything you want to add the similarities between the products and maybe some of the challenges that are associated here?
Yeah, I think, look, GLD took us from the initial listing to initial filing to listing was just over a 2-year process. If we put that in the context of Bitcoin filing, we go back to Winklevoss back in 2013, which seems, decades ago. So that's 8 years and counting. So there's obviously a bit of a difference. The similarities between the underlying assets in this case is, at the time of their filing, both gold and Bitcoin in this case were relatively unknown asset classes, particularly to regulators and more importantly, frankly, to the wider professional investor markets. When it came to our interface with the SEC, there was a lot of back and forth in terms of explaining, what is the nature of this asset? How does it trade? Is gold primarily traded on regulated futures exchanges, or is there a large global over-the-counter market? And if so, are there any regulated over-the-counter exchanges for gold? In this case, the answer is no, which also holds true for Bitcoin. Some of the differences, and I know we were going to get to this in the next session, so maybe I can hold fire for a little bit.
Yeah, no, that makes sense. So, Bip, you talked earlier about the fact that Bitcoin is not a security. And so therefore, if a fund that holds Bitcoin directly, it won't be treated as an investment company. So there have been a number of firms that have filed S1 registration statements to have an ETP registered to hold Bitcoin. There have been, and you both have alluded to the rejection letters that have come forth, the Winklevoss rejection letter, Bitwise, and Wilshire had one not too long ago as well. And those have all come out. They've been pretty lengthy rejection letters for the product, as far as the 19B4s that were filed in order to have these products listed. In corporation finance, where the division that reviews the registration statements for disclosure purposes and other purposes, they decided not to review the registration statements until there was some more clarity in trading and markets with respect to the 19b4s. So we don't really know what corporation finance thinks of an ETP. We certainly know what trading and markets under the last administration thought about it. What do you, I mean, based on the rejection letters that we've seen, and Jason, I'll put this to you first. Based on some of the rejection letters that we've seen, what do you see as the biggest issues that the SEC staff raised in those rejection letters that need to be resolved in order for an ETP to be approved?
Yeah. And I think we have to go back to the original, again, to the Winklevoss filing, and really understand how the market for Bitcoin has changed so dramatically since that time. If you remember back in 2013, many of us probably had kind of heard of Bitcoin. It's kind of this computer nerd project, etc. It was the preferred currency of drug dealers on the dark web. It was the preferred currency of global computer hackers who did these, broad-based global hacking activities. And then you had numerous situations where exchanges, either through hacking or, frankly, straight bankruptcy, you had Bitcoin go missing. So people had the asset value basically disappear and go to zero. That doesn't happen in too many other asset classes. Now we have the situation where we have Tesla and Elon basically saying this is a reserve currency. It's part of our treasury operations now. So I think the credibility of the market itself has increased dramatically. That being said, at the same time, the size of the Bitcoin market has expanded dramatically as well. I think in terms of total outstanding market cap now, we're about $860 billion market cap for traded Bitcoin. Which is obviously quite a bit higher than it was certainly back in 2013. So those are things that I think are helping the situation. I think there were major concerns also from the SEC in terms of Bitcoin's volatility. And also, what is the potential for a complete loss? Meaning, is there potential for Bitcoin to go away, for its price to go to zero, nobody uses it? I think the probability of that back again in 2013 was much higher. I'm certainly not saying it was a probable event, but it was certainly higher than it is now. In terms of volatility, interesting fact, in 2020, 30% of S&P 500 stocks were more volatile than Bitcoin. The biggest hurdles in my mind is, and what I think the market is waiting for, is Bitcoin futures at the CME becoming a substantial size. Of the kind of global exchanges, we know there's like 6 or 7 global futures exchanges. Unfortunately, only one of them is a member of the Intermarket Surveillance Group. All of the other exchanges, they're not self-regulatory exchanges. They don't have legal ability to reach out and discipline their members. And so they can't be members of the Intermarket Surveillance Group. So the potential for manipulating the price of Bitcoin is also a huge concern. So as CME Bitcoin futures become significant size, and there's debate about where is that inflection point, I think we are fairly close to it. That will be, in my mind, kind of the tipping point. So the listing venue for the ETP, the Bitcoin ETP, needs to have an information or surveillance sharing agreement in place with a well-established futures market. And that, in this case, will be CME.
Okay, that makes a lot of sense. We got our first question, and that's going to segue into into the next thing we're going to talk about anyway, which was, Bib, you talked a little bit about the Grayscale product that's out there, and it has some features of an ETF or an ETP. in that it issues the shares in creation baskets, but it's a private offering, so they only offer to accredited investors, and then there are holding periods associated with that, and the ability to trade the shares after the holding period expires, but it's over the bulletin board. You don't have the same sort of price discovery. You don't have arbitrage the way you have with an ETF. But Grayscale, because it's one of the biggest games in town, it has about 25 billion in assets. The spread between NAV at times has been pretty extreme, but at the same time, it's a product that is out there and that individuals and and funds are investing in order to get Bitcoin exposure. Vic, can you briefly talk about the price discovery process that works for an ETF and how it doesn't work quite as well for a product like Grayscale? What are the differences in the nature, because it's a private fund, doesn't have the same sort of mechanisms in place for it. If you could walk us through that, that'd be great.
Sure. Oh, and yeah, and I think really the key is the arbitrage, create, redeem process, and the exchange, those working together. And that's why, Grayscale is at 25 billion, and the ETF industry is, I don't know, 5-6 trillion. And really that process drives the price of the share to the actual net asset value per share of the product. And as those get farther apart, it becomes a less attractive product for an investor because there's a disconnect, between the share price and really the intrinsic value of the pro rata share of the group of assets that you're owning. So, why it works so well in the ETF world, like, for example, spiders. Let's say the shares are trading at a discount, the spider shares, from the ETF's net asset value per share. Well, the arbitrager can go out, he can buy those ETF shares on the market, and then he can present those to the ETF issuer, for example, spiders, and then get a basket of securities in exchange for those ETF shares. So in effect, he's buying that basket of securities at a discount from what he would have bought if he bought them on the open market, and he can turn around and sell them for built-in profit. And it works the opposite way. If the ETF shares are trading at a premium, there's an opportunity for an arbitrage to exploit that difference. So this would be great for Grayscale, if they had this mechanism, but because of the way the securities are registered and they're limited to accredited investors, and as you mentioned, Owen, they're subject to holding periods. They're not allowed to have that feature, and they recognize that. I'll read real quickly from their offering document. It says shares are not redeemable by the trust due to the lack of an ongoing redemption program. And other reasons, there can be no assurance that the value of the shares will reflect the value of the trust Bitcoin. So, and they go on and say that, there's no assurance that the value of the shares will reflect the value of the trust Bitcoin holdings per share, and the shares may trade at a substantial premium or substantial discount to the value of the trust Bitcoin holdings per share. So, and that's not to say to criticize the product, because believe me, they wanted it to be fully registered and listed on an exchange, and that would have allowed and facilitated the create redeem process that's available to securities-based ETFs, and then you would have not had that issue. And in fact, I'll just mention quickly what they said about that. Again, in the offering document, because the trust does not have the ability to redeem shares until given the authorization by the SEC, the trust may not meet its objective for investment, which is to provide investors a cost-effective and a convenient way to invest in Bitcoin while avoiding the complications of holding the Bitcoin directly. So, that's the optimum structure is the structure that for now, the SEC is not allowing, and it's significantly retarding the growth in funds that invest in in Bitcoin.
Great, thanks, Vid. So Jason, you were when your firm Cryptoin, decided that they wanted to get involved in this space. You were aware the Grayscale product was out there, and you decided. Well, there are other products too, and feel free to. We don't have to pick just on Grayscale. I mean, there are other products out there that have similar. And it's again, like Viv said, there are limitations that are imposed by the securities laws in some cases. But walk us through your thought process for why you decided that you wanted to continue to focus on the ETP structure and how the benefits that has over some of the others that are out there in the market right now.
Yeah, thanks. So this is kind of a controversial subject. From a purely business perspective, I think these Grayscale and the like products are absolutely fantastic, right? So they've got 20 some odd billion dollars in AUM, charging 200 basis points plus. It's absolutely fantastic. Where the issue comes is when those things are eligible for trading in the over-the-counter market, you have retail investors willing to pay huge premiums to access these vehicles. So, I know the Grayscale prospectus says, well, this could trade at a discount. It's never traded at a discount, and it never will to NAV. So their premium has ranged. It's been as high over 100%. I think recently it's been range bound between 20 and 60%. So you've got this huge, supply demand imbalance when it comes to retail investors. They're willing to pay huge premiums to access the products. For many who are not accredited investors but do have 401ks and IRA accounts, this is frankly the only game in town that I can buy through my brokerage account and have in my retirement account. This is kind of one of the rare situations where for a retail investor perspective that buying the exchange traded product is less cost effective and in most cases less cost efficient than buying the underlying assets directly. So what do I mean by that? On one hand, because these are Reg D private offerings, if I'm a retail investor and I don't make enough money or have enough assets under my name, then I cannot buy at NAV directly through fund subscription. I'll have to wait until they're traded on exchange. So from one perspective, you got the SEC saying, well, you're not sophisticated enough, so you cannot buy this fund on a private placement basis. But why don't you wait and buy it on the exchange when it trades at 100+% premium to actual NAV? That's fine. I don't get it. Now, perhaps I'm taking the quite pure view of this, but if the SEC is in the business of protecting investor interests, and this is all brought to bubble recently with the whole GameStop fiasco, I'm not sure these things are very effective products for retail investors. So, paying a 20% premium to net asset value is not cost effective. Now, since I said I wouldn't pick on, or we said we wouldn't pick on Grayscale only, I'll pick on Bitwise now. Bitwise has a Crypto 10 index fund that they launched in 2017. They then, as of December 9th, 2020, so just before the end of the year, they got the ability and listed their fund, their crypto index fund, in the OTC market. Now, in the span of the fourth quarter, their AUM in that fund grew from 100 to $700 million. Their Q4 inflows were more than 2018 and 2019 combined. So why is that? The only thing that changed is this thing is now available in the over-the-counter market. It's not as if accredited investors suddenly discovered this product is available. They could access it through the Reg D subscription. That fund has traded at an NAV premium of up to 649% to NAV in mid-December. In early January, the premium was 130% to NAV, and recently, as of a couple of days ago, it's 85% premium to actual NAV. How can we call this kind of value for end investors? And it also kills your tracking error as well. So total returns year to date on the NAV shares are around 44%. The over-the-counter shares are 7%. So depending where you buy or sell on that NAV premium, it could work out in your favor, or it may not. So they're kind of toxic instruments. So I think disclaimers in those products should be bold and probably a few font sizes larger, saying that these things the traded price in the over-the-counter market can vary widely from net asset value. My hope is that the SEC will approve an ETP with an arbitrage pricing mechanism. That is the ultimate goal. It levels the playing field. That's the whole point of having an ETP in the first place, is democratization of investment, meaning institutions and retail investors pay the exact same trading cost for accessing that fund. It's the same price to everyone involved. And that's kind of the magic in the product. So there's no institutional share class, there's no 12b1 distribution fees, there's no different expense ratios, there's no rebates for distribution in ETPs as well. So that's the holy grail. It becomes more and more difficult for a firm like mine, seeing that these kind of Reg D offerings with over-the-counter windows are kind of scooping up assets at the rate they are. But it's not an easy decision to kind of stay the course and say, no, we're going to go for the real ETF with the real create redeem mechanism.
Thanks, Jason. And I think that leaves us with the last topic we want to discuss, which was, we know that the prior administration, Chair Clayton, I think, was pretty clear that he was not in favor of a Bitcoin ETP, and the rejection letters made that abundantly obvious. So, Biv, where do you think things stand with the new administration, and assuming that Gary Gensler is confirmed as chair, what do you see the prognosis? And I'm sorry, but you only have 1 minute.
Yeah, well, luckily there'll be a fresh look. And I'm hoping they go down the path with the ETF. When I was there back in the 90s, while investment management didn't have too much issues with it, trading in markets, then market reg felt like, wow, this is a risk. This could have a two-tier equity market that disrupts the primary markets where securities exchange. Yet they were bold enough to allow it, and it's actually improved the quality of the markets for securities. Much like, hopefully, like Jason's alluding to, not only making this available to everybody at the same price, but it actually could improve Bitcoin as a medium for an investment by having professionally managed funds holding it.
Great, thanks, Biv. I know we have some other questions that we tried to get to a couple of them. We didn't get to everything. What we can do is we will respond to those after the fact, and we can, to the extent we can, we'll respond to those outside of this presentation. But unfortunately, we're at 11 o'clock. That concludes today's series. The next coffee chat in the series will be hosted next Wednesday, February 17th. Our colleague Mark Miner will be joined by Tracy Stewart, the Corporate Governance Manager for the State Board of Administration of Florida, to discuss diversity in the boardroom and the new proposed NASDAQ rules. To register for future Coffee Chat discussions, visit the events page on the Thompson-Hein website. Thank you for all your interest in attending today's program. When the webinar ends, you'll be prompted to take a survey providing feedback. This feedback is very important to us and helps us continue to tailor our programs to your needs. Thanks again, and enjoy the rest of your day and stay well. And thanks to the panelists for joining us. Appreciate it today. Thank you very much.
Thanks for having me.
Thanks, Owen.